Hi, welcome to Market in a Minute. So, in my family, on the first of the year, we have a big sauerkraut dinner. It's supposed to bring you prosperity and good luck. So, I had a lot of sauerkraut, man. So, I'm hoping for another really good year in 2026. We think we're going to see acceleration of the trends that started in the second half of 2025. We have a very detailed analysis of all this. So getting right into it. So the prize du jour was Venezuela. Um, I think that's going to be a big positive for this, the southern hemisphere, southern part of our hemisphere, and probably way overdue. It's going to be good for growth for the country there, and also it'll keep oil prices here low. So it's a win-win for everybody. The S&P 500 up double digits now for the third year in a row. So there have been three other times when a market's been up four more years in a row. And those were 1995 to 1999. That was 5 years. 82 to 86. That was 4 years. And then 1942, there were, again, 4 years there. So only three other times where we had 4 years or more of double-digit returns. In general, we think it's going to be a tougher year than last year, and we could have a double-digit year this year, but we think it's going to be tougher. We would probably we're probably more likely to see a single-digit year, but we could see double-digit. So there's a lot of really positive things in place to drive the markets higher. So we see a very similar environment in terms of volatility in 2025 as we had in 2026. So we had a 19% pullback last year. Do you remember that? Bottomed in April, and then it rallied to be up 16% on the year. So that's quite a move. You want to be in tactical money management at this point in the cycle. Liquidity, it shrank a lot last year. Most people didn't realize that, but liquidity in the financial system was not great. Now, with the Fed buying back T-bills, we think the liquidity is going to be better. And if there's a pullback, we think the liquidity is going to be there to support, buying that pullback. We think the Fed will continue to cut rates. We expect one more rate cut in March, a new chairperson to come in to the Fed, and then see two more in the back half of the year. So we think inflation is going to be controlled to allow these rate cuts. More initiatives will come out of Trump to focus on housing and healthcare. So we think those are going to be very, very big election issues. And housing, I think that's probably still right in the works and to come out soon. And healthcare, they need to come up with some sort of better way of our health system to keep the expenses low. And one of the ways is to eliminate the fraud. So there's too much money in our system for all the additional people that should not be receiving it. But anyhow, healthcare will probably be a big focus and turn into a positive for the economy. So the economy is gaining momentum. And a lot of those sectors that were tired, that went into a recession after COVID or during COVID and didn't come out of it, we think that a lot of times passed, and now because times passed and pent-up demand, they're going to start to improve. The PE of the markets are capped, in our opinion. So at 22 times next year's earnings, and the earnings are high, or 22 times this year's earnings, I should say, and the earnings expectations are high, we think that it's going to be hard to see a lot of PE expansion. Maybe some, but not a lot. And we should see an accelerating trend in terms of the economy. We're a little concerned about a couple of things. So we're concerned about the 10-year Treasury yield rising. And because the economy is good, it could go up. But we think that there's some mechanisms in place to maybe bring the 10-year Treasury down. With 48% in technology, there's really never been another environment like this with so much of the S&P 500 in tech. And actually, if you're a fiduciary, you can't have 48% of your portfolio in tech. Something to think about there. So as the tech gets unwound, if it's disorderly, it could cause a nice sized correction in the overall markets in 2026. Then we need to start to focus on 2027. 2027 should be a good year. Should continue to see nice growth, and hopefully that shapes up. If not, then we're going to see a peak in the market in 2026. The risk is the midterms. So we're looking at the midterms of bringing some anxiety into the overall market. So we might see during that seasonal period in August, September, October, in front of the election, some of that anxiety to come into the overall markets. If we were trying to pick the exact point, we would say maybe it's when we see the SpaceX IPO. I'll talk about that in a second, or in that weak period of the overall seasonal weak period of the overall markets in front of the election. So our outlook for 2025, it was pretty darn good, I gotta say. We called it a year of change, and certainly saw a lot of change, didn't we? Now, this year is a year of acceleration. So we think that things that are being put in place, the policies in place, will start to accelerate the economy, and we'll see some of that acceleration of the different sectors of the economy besides just tech to start to improve as we go through this year. So we think that as we go through the year, that acceleration is going to kick into high gear. Could be a lot of fun. We expect that GDP growth to be higher in 2026 than it was in 2025, and could be surprisingly strong. Now, here are the Trump policies, and it reminds me a lot of Reagan. So lower taxes, incentives to invest in property, plant, and equipment. Reagan, right? Incentives to produce, goods in the U.S. It's more of a penalty if you don't. So tariffs. Tariffs have kind of filtered through the system, and this should be passed by now. So any sort of price issues should move on, but it brings the growth back to the United States in terms of manufacturing over time. Lower regulation. This is Reagan-esque all over. Increased defense spending. That's Reagan as well. Pro-energy production. Lower energy costs. I think we're going to see that continue on into 2026. More efficient on government. Smaller government. Hopefully they can get their grips around bringing the government into a more normal weighting of the overall economy. And then AI and cryptocurrency. Obviously, this is not a Reagan policy, but if it was around, it certainly would be. And then prices coming down because of more production capacity. So that's very Reagan-esque. So Trump took a big page out of the Reagan's playbook, and it's starting to play out. Again, when Reagan was in office, we did have that 1982, 1986 bull market. So it could continue for a couple years, but we also had a lot of volatility during Reagan as well. Earnings are expected to accelerate in 2026 to roughly 15% from what it looks like about 11.5%, 12% growth in 2025. The slowest sector is real estate at 5%. So real estate could actually turn out to be a nice place to invest as well, as that's starting to improve. So the Mag 7 stocks, we're seeing some rotation coming out of that. We think that'll probably continue into 2026. And in 2025, we do expect a correction to occur. So you got to be on the watch out for this. We think it comes back, maybe not as strong as it did in 2025, but the market comes back. And depending on what the timing is, we should have a good year, a reasonable year in 2026. But again, we think that there'll be a correction to occur sometime in 2026. And then continue on with this. The expectations for technology are really high. So continue on with the earnings growth now by sector. So we got it by the S&P, now by sector. So it's already expected that technology earnings will grow by 29%. So we have high expectations in the tech group versus 24 last year. So it was a good year last year, 29% in 2026. We think that's what's happened is that we brought all those expectations forward a little bit too much. So the market feeds off of beat and raise. So beat the earnings expectations and raise the number. Well, the number's been raised quite a bit. It's going to be hard to beat those numbers unless it's a cyclical part of technology. We see that maybe occurring. The Mag 7, only two of the Mag 7 outperformed the S&P last year, which were Google and NVIDIA. We think we're going to see something similar to that in 2026. So 2025, two outperformed. And 2026, we think there'll be something similar. There'll be a couple, maybe a number of IPOs, but a couple that'll be really interesting coming from Musk. And SpaceX and Starlink should come public next year. We think, or in 2026, we think that SpaceX, depending on the timing, all the hoopla around it, all the speculation around how good it's going to do, and then the soaking of the capital might turn into the high point of the market in 2026. So a major factor, gotta have this in the forefront of your mind, is interest rates. So interest rates continue to come down, but the long end is where the risk is. So we see lower inflation and because of energy and housing. And so inflation should come down, interest rates should come down, and that'll be a very positive trend for the overall markets. If that doesn't occur, that's not going to be good. Trump will focus on affordability, as we discussed, housing in early 26. We think that there'll be some big initiatives in place to increase the housing stocks, likely take out a lot of the regulations that's been holding back increasing the supply of housing. The Treasury Department, I think they're going to shrink the relative number of 10-year Treasury bonds out there to help bring down the mortgage rates. So the mortgage rates have been artificially too high relative to Treasuries. The Treasury Department can help, and a new Fed chairman can realize what's going on there and address that issue. So as a theme, we really like cyclical stocks, and we like the housing area. We don't think technology is going to fall apart. There's going to be some good ways to play tech, but we think that there's this acceleration of this rotation to occur in 2026. Biotech, okay? Biotech's probably going to be a big winner again. Yay, biotech, right? We love biotech. So some of our names did really well in 2026, or 2025, sorry. And we had some that didn't do so well. But we had a big year in biotech, and we think it continues into 2026 because the major drug companies, they're seeing their prices being lowered, so they had to find new products, and they have a lot of drugs coming off patent between now and the end of the decade. So they need to fill their pipelines with new drugs. So all the new drugs are coming out of these smaller companies, generally speaking. And we think it could be time for small caps. Okay, small caps are breaking out. So they broke through their old resistance. They're making new highs. I see strategists out there that have expectations for twice the growth in earnings of small cap versus the S&P 500. So on a relative basis, should be a better year. If interest rate drops, that's another big positive to small caps. The smaller cyclical companies should do really well in this environment. The PEs for the market are over 22 times. So we have 22 times a 2026 earnings estimate that is already expected to be up 15%. Those are high expectations, both on the multiple and the earnings. So I think it's going to be a challenging year with a nice size correction to be followed by maybe a nice, comeback rally at some point. So we plan to take advantage of this volatility. So you got high expectations. Nothing ever goes smoothly, right? So something's going to change. The market's going to turn negative for a period of time. But all these policies that are in place that Trump's doing, the new Fed chairman, and a smart person running Treasury, I think it sets up for a very nice environment overall, and we could have a double-digit year. Now, review of 2025. So give you a basis of where we're starting from. S&P, as I mentioned, up 3 years in a row, double-digit. NASDAQ up 20% last year. That was a big move. So value, actually, the Russell 2000 value outperformed the Russell 2000 growth by a little bit. So you could see that there's a bias maybe towards value stocks. And then the IFA, so international, up 27%. We think that's a total fluke. I don't think that's going to happen again. But some markets were up huge last year. Technology, as I mentioned, big winner, up 23%. And the communication services, that's technology, up 32% last year. These were big components of the S&P 500, had big moves. So we're starting to see some of those other sectors perform better towards the latter part of the year, 2025, and we think that maybe continues into this year. So you can see what's underperformed, consumer discretionary. With these big tax cuts coming, they were up only 5% last year. We think that this could be a really good area. The staple stocks, now maybe it's not the right point of the cycle where you want to own these. They were flat last year. So time's gone by, you should see some consolidation, should see the cloud lift over these stocks because of the health issues that RFK is trying to address. That'll happen at some point. There's real value in these names. So we're going to pick off a couple of these. And then healthcare, we continue to like healthcare. Financials, we like the financials. We think that some of these financials are getting a little extended, though, relative to their historical valuations. Energy stocks basically didn't do much. And I think what's happening is that in the energy sector, people are starting to look out further. So I think everybody was assuming maybe a couple years ago that the energy sector, i.e. oil, had maybe a 20-year life. Well, that's probably changed. That 20-year maybe is turned into 30 years or 40 years life or longer. So I think the market's starting to realize that these companies aren't going to go away and that this is a critical part of the global economy. So energy could be a surprise. So if we get an opportunity to buy something on a dip there, we'll definitely do that. And then real estate, down a little bit on the year. We think that real estate improves and that there's some opportunities in the real estate sector as well. So as we go through the year, we're seeing that continued rotation out of some of these, big cap, mega cap technology stocks, that the AI trade, maybe it's getting exhausted because it's such a large part of the S&P 500. And the economy will grow in other sectors maybe faster now than what it was, and that the AI infrastructure spending, big dominant part of the economic growth, will become less of a dominant part of economic growth. So again, we like the setup for this year, except for that there's going to be more volatility, and we have high prices, high PEs, and high expectations of earnings. As we get opportunities, I think that's going to give us some nice, really good buys. And we have a lot of stocks that we think fit those sectors that we described. So the housing sectors, we got a lot of stocks we like in that housing sector, healthcare as well. So on and on. The underlying stocks of the market, as I mentioned, the equal weight only up 12% last year as the market was up 17. Well, there's opportunities in those equal weight stocks. So below the mega cap stocks, there's opportunities. So disclosures, just in general, this is coming from me. It's my views of the world and stock market. Please read the disclosures. And all investments involve risk and are not guaranteed. Can you believe that? Well, we hope we have a great year. If you have any questions, come to my website, Patrick Adams, CFA. You can locate how to communicate there, or come to my employment, PVG Asset Management. You can talk to us through our website there. And please look at the strategies we have at PVG. Lots are tactical. We had some really good returns, both in the short term and the long term. So I'm sure you'll find a strategy if you're looking to have your money managed by one of the strategies we have at PVG. Take care, and we hope we have a great year.